All right, today we are digging into a classic market puzzle, and it's all about Oil States International, ticker OIS. So the company just dropped its Q2 earnings, and, on the surface, the numbers looked pretty good. But the way the market reacted, whoa, it told a completely different and way more brutal story. Okay, let's just get right to the heart of it, because this is the big question. The company beat expectations on adjusted earnings per share, and yet the stock got absolutely hammered, dropping over 11% on the day. So what's the deal? What did Wall Street see that the headline numbers didn't show? Let's break it down. So first, let's just set the stage here with the initial numbers that came out. When these results hit the wire before the market opened, they seemed totally solid. But as you're about to see, the story was hiding in the details. Okay, now check this out, because this is where the plot thickens. The adjusted EPS, 9 cents. That's at the high end of what the street was expecting. Awesome. Adjusted EBITDA of 21.1 million, right inside management's own guidance. So far, so good, right? But there it is, our first big clue. The revenue. It came in at 165.4 million, a $5 million miss. And that's what caught everyone's attention. And boom, here's the market's verdict, a painful 11% drop in one day. This is that huge disconnect we're here to figure out. See, the market wasn't trading on that little earnings beat. It was trading on that revenue miss and, more importantly, why it happened. So how do we decode a reaction like that? Well, we've got to look under the hood of the company. What's really going on is that Oil States is basically living through a tale of two completely different businesses, all at the same time. This chart tells you pretty much the whole story in one picture. Just look at that revenue mix. A whopping 72% of the company's money is now coming from its offshore and international work. The U.S. land business, it's shrunk all the way down to just 28%. And let me be clear, this is not just some cyclical dip. This is a massive, deliberate, strategic pivot by the management team. And this slide lays out those two stories perfectly. On one side, you have the offshore business that is just firing on all cylinders. Their backlog, that's confirmed work they have lined up, hit $363 million. That's the highest it's been in a decade. They're booking new work faster than they're finishing old work. This is the growth engine. Then on the other side, you have the U.S. land business, and it's in a managed retreat. Activity is falling, so what are they doing? They're closing facilities, they're cutting staff, and they're doing it all to protect their profit margins. Two totally different playbooks. And hey, you don't have to take my word for it. Here it is, straight from the CEO, Cindy Taylor, on their earnings call. This shift is intentional, and it's happening fast. They are actively choosing to lean into that long-term, higher-margin offshore world and step away from the choppy, unpredictable U.S. land market. Okay, so with this huge strategic shift going on, what's the game plan? What is management telling investors to expect? And maybe more importantly, what are they doing with their cash? This is where the story gets really compelling. Now, the crucial thing on this slide is what they didn't change. Look at that. They kept their full-year guidance for adjusted EBITDA exactly the same. That is a massive signal of confidence. They're basically saying, yeah, we're lowering our total revenue forecast because we're getting rid of some of that less profitable land business, but don't worry, we can still hit our profit targets. They believe that better margins from the offshore side are going to make up the difference. And here's what they're doing with their cash flow. It's a super clear three-pronged attack. Number one, get the balance sheet stronger by buying back debt. Number two, give money back to shareholders by buying back their own stock. And number three, invest in the future of that booming offshore business. It's a really balanced and disciplined approach. We keep talking about this backlog because it is easily the single most important number in this whole story. That $363 million, think of it like a giant pile of confirmed paychecks for high-margin work that they just haven't cashed yet. It gives them this incredible visibility into the future that the U.S. land market just can't provide. It's really the core of the whole bull case for the stock. All right, so we've dissected the numbers, we've gone through the strategy, and we've seen the market's, let's say, emotional reaction. Now it's time for our segment, The Next Call, where we give you our take on what this all means for the next quarter and beyond. So our rating on Oil States International is a firm outperform. Plain and simple, we think the market's big sell-off was a huge overreaction, and it completely missed the bigger picture of what this company is becoming. So here's our thesis, boiled down. The market punished a messy transitional quarter. It just fixated on that headline revenue miss from the shrinking land business and hit the sell button, while totally ignoring the powerful, high-margin offshore engine that's revving up with a record backlog. So what's our prediction for the next earnings call? We expect that offshore backlog to stay strong, and we think we're going to start to see the financial proof of that land restructuring, meaning better profit margins. That combo should force a big shift in how people feel about this stock. So the trade? Go long OIS shares. Right now, the market is pricing this company like it's in a cyclical downturn, not like it's in the middle of a successful strategic pivot.
And just a final quick reminder, of course, this analysis is for informational purposes only. It's based on public info as of September 14th, 2025. And this is not financial advice.